Hello and welcome. Welcome to our next NAP. My name is Irina Oreshkova and I'm your nonprofit auditor. Today is next NAP. NAP stands for Nonprofit Auditor Points. This is not authoritative video. In my NAPs, I just share my experience as being an auditor for many years serving nonprofit organizations. I know that accounting and auditing topics can be complex and confusing. Hopefully, my short NAP videos help nonprofit communities to get a better understanding of some accounting and auditing questions and issues. However, if you have any specific questions pertaining to your nonprofits, please contact your own auditor or you can contact me. Thank you so much, and let's start. Today, I want to talk about accounts receivables and contributions receivables. Sometimes contributions receivables also can be called pledges receivables. What is the difference? In my practice, very often we can see that accounts receivables and pledges receivables all lump sum together in one account. And very often nonprofits not sure why they should be separated. And are they really different? In our previous snaps, we talked about two different types of revenue that nonprofits have. One type of revenue called contributions, donations, or gifts or pledges. They are unconditional promises. Another type of revenue, it's governed by Standard 606 revenue recognition, and they are exchange transactions, and they recognize as revenue when they are earned. Two different types of revenue. Therefore, for each type of revenue, we have different type of receivables. So let's see how accounts receivable and pledges receivable or contributions receivable related to these two different type of revenue. Okay. Let's take a look at contributions receivable first. Again, contributions receivables can be called pledges receivable or gifts. And as we mentioned before, they recognize as revenue when they are unconditionally promised. This type of revenue, if paid in advance before nonprofit is entitled to these funds, create pledges or contributions receivable, not accounts receivable. Pledges or contributions receivable. Let's take a look at an example. City of San Francisco gives $50,000 grant to nonprofit to serve homeless in the district XYZ. It's unconditional promise because there is nothing specifically City of San Francisco asking nonprofit to do or achieve. It's just asking overall what it needs to be done. Nothing specific, no condition. Let's just say the date on this grant letter is December 12th, 2024. And when this grant is received by a nonprofit organization, it has to be recognized as revenue on that day because there is no condition. But if the funds were not received yet, so nonprofit will recognize pledge or contribution receivable for $50,000 and revenue $50,000. It's not accounts receivable, it's pledge or contribution receivable. Only pledge or contribution receivable can be short-term and long-term. Same example can be changed slightly, saying that City of San Francisco gives $50,000 for nonprofit for 5 years. It will be paying $10,000 annually to serve homeless community. Again, there is no specific barriers, so it's unconditional promise. Nonprofit would have to recognize as soon as that letter was received from City of San Francisco, pledges or contribution receivable for the full amount, $50,000. Pledges receivable and revenue for $50,000. Now, that $50,000 in receivable, pledges receivable, will be $10,000 short-term receivable, pledges receivable, and $40,000 long-term pledges receivable. Why? Because first $10,000 will be received within 12 months, so it's a short term, and the remainder, $40,000, will be received in the year 2, 3, 4, and 5, long term receivable, contribution receivable. Another possible scenario for pledges receivable, that City of San Francisco gave the grant. It says that nonprofit has to serve homeless community, and City of San Francisco will give $50,000 for that. However, nonprofit needs to shelter 20 homeless individuals in the year of 2024 in order to be entitled to this grant. Otherwise, nonprofit have to pay funds back if this measurable barrier is not achieved. This is a conditional grant because it has very specific requirement that nonprofit needs to house 20 homeless individuals in 2024. Until that barrier is met, nonprofit cannot recognize this as a revenue. Therefore, if the letter is received and nonprofit did not meet that barrier yet because 2024 is not over, nothing will be recorded because it's this condition. But let's just say City of San Francisco still sent $50,000 check. A nonprofit receives this check. That would not be revenue. That would be advance on possible grant. Therefore, this needs to be recorded as a liability, would be refundable advances. Nonprofit will receive cash, debit cash, and credit refundable advances. Therefore, there are 3 accounts that related to grants or contributions or pledges. If it's revenue, it will be grant revenue. If it's receivable, it would be pledges or contribution receivable. And if it's liability, it would be refundable advances. It's very important to know that terminology to proper differentiate 2 types of revenue. Once again, we just discussed how contributions or grants revenue work. Friendly reminder, contribution or grant, it's when one entity provides funds to a nonprofit to serve somebody else. Like in our example, City of San Francisco provided funds to nonprofit to serve homeless individuals. There is no exchange transactions. City of San Francisco does not receive anything in exchange for these funds that they pay. Now, let's take a look at another type of revenue. It's earned revenue under Standard 606, which needs to be earned and recognized as revenue when it's earned and services provided. It doesn't matter when the contract is signed or agreement is achieved. It's when the services is provided. This is another name for that exchange transaction. Why it's exchange? Because it's exchange of consideration. One party paying for services, another party is providing services. When the considerations are exchanged, revenue is earned. Let me give you an example for that kind of revenue. This type of revenue let's go back to our example. If the City of San Francisco pays $50,000 to nonprofit to provide training services to the employees of the City of San Francisco. Maybe it's a safety and security training. So City of San Francisco will pay its consideration to the nonprofit, and nonprofit will provide training to the employees of the City of San Francisco. That's another consideration from the standpoint of nonprofit. So when the contract is signed, nonprofit will not record anything because it's just a contract. Nothing has been delivered and exchanged yet. Let's just say if nonprofit provided training based on the contract and the City of San Francisco have not paid yet. So as soon as the training was provided, let's just say it was December 12, 2024, nonprofit will record accounts receivable because it's an earned revenue for $50,000 and earned revenue, $50,000. So it can be fee for service. That the point when we record revenue, and that will be recording accounts receivable, not pledges receivable, accounts receivable. Let's just say another example, if City of San Francisco signed a contract with the nonprofit to provide training services on December 12, 2024. However, on December 1, 2024, City of San Francisco sends check for $50,000. At that moment, that not earned revenue for the nonprofit. Therefore, before the service is provided, and if nonprofit received payment before the training, nonprofit have to record a liability called deferred revenue or unearned revenue for $50,000, debit cash $50,000, and credit liability, which is deferred revenue or unearned revenue. It's the same name. Therefore, for earned revenue for fee for service, we have three different accounts. We have fee for service or contract revenue, that's revenue accounts. Liability, it's going to be deferred revenue or unearned revenue. And if the funds paid in advances, that's going to be accounts receivable. Accounts receivable, by definition, cannot be short-term or long-term. They are due as soon as they earned. So they are short-term. Only pledges receivable, as we discussed before, can be short-term or long-term. And on financial statements, if it's classified financial statements where the assets split between short-term and long-term, they need to be presented accordingly. And it's also very important for nonprofits, for liquidity standpoint, understand if there are pledges receivable, when the cash will be provided. Because pledges receivable can be quite material number, but if they paid within the next 5 years, they might not be liquid enough for nonprofits to consider them as a liquid asset, meaning that they will not be providing cash within the next 12 months. So once again, to summarize, contributions or grants revenue will form the following three accounts: contribution revenue, grants or pledges or contributions receivable, and refundable advances as a liability. Earned revenue will create fee for services or contract revenue, unearned or deferred revenue as liability, and accounts receivable if the funds paid in advance. So this is the definition, or this is the difference between accounts receivable and pledges receivable. Hopefully it was useful, and hopefully you enjoyed my little presentation. Thank you so much for listening. As always, really appreciate your support, and see you during the next nap. Have a wonderful day. Talk to you soon.